What mistakes do dividend investors make and how they can avoid them?
Yeah, because I think dividend investing, you look quick and you're like, oh, like I just invest.
Oh, I got a 5% yield.
Yeah,
Awesome.
Like, I'm going to be getting that every year, right? And like you just kind of factor that in as your rate of return if you're just doing like a quick, oh. So I think one of the big things people need to be cautious about is being yield centric. And kind of like we mentioned, you might be tempted to use a yield as your screener, right, when you're looking at dividend stocks or potential investments. And I think it's definitely a good place to start, particularly if that's your orientation. But it's something that you definitely need to dig deeper on. So some companies in the tech space, other sectors as well, have these very gaudy yields. But you need to read into why that's the case. Sometimes that's because there's been huge share price depreciation, and so
which implies some sort of trouble.
Yeah, and so it's easy for a percentage to go up when the denominator goes down, right? And so just as an example, I think Seagate's dividend yield is like 7%. In the past year, the stock has lost half its value. So that is not necessarily a sustainable 7%.
That is not why you want that yield, yeah.
Right. And part of that is because the business is struggling. They've missed on reports recently on some of their quarterly filings. Customers seem to be moving a little bit more towards solid-state drives than Seagate's flagship magnetic disk drives. So there are all these competitive and just business elements at play here that ultimately undermine, the long-term viability of that dividend and the yield that it currently is.
On the other end of the spectrum, you picked a couple of names that don't have that sky-high yield, but long-term...
Right, yeah. And so, again, only looking at yields might cause you to miss out on some of these kind of like best of both worlds growth stocks that also have, a nice little dividend as a kicker. And no one's going to be surprised to hear this name, but Apple, they make everything, and like they are a fantastic growth company. They have a great growth profile, and they have a nice little dividend yield. It's like 1.75%, something like that. And I don't think anyone's going to argue that company's not going anywhere. Like they're going to be around for a while.
Not only that, but the odds of them just upping that just a little bit for the next 1 to 2 decades, probably pretty good.
Yeah, and
that's really what somebody that's looking to build a long-term dividend portfolio, like John earlier, should be looking for. Something that's yielding 2 or 3% right now and is not guaranteed, but probably going to up it later.
Yeah, and it's something where you'll probably enjoy some very nice share price appreciation along the way.
Fingers crossed.
Because of those growth drivers. Yes, I'm a shareholder, so I hope so. And just another name, and kind of in the same vein, where if you're only looking at 3% and above on yield, something like that, you'd miss somebody like American Tower. So they're an owner and operator of wireless and broadcast communication sites. They're in a couple
mildly
different
important today. Huge barriers to entry. Who has the money to build those stupid things?
Yeah, and they lease them out.
Yeah,
wireless carriers.
Boom.
And so huge barriers to entry, capital intensive business. And you look at the macro factors at play. Cell data is huge. It's going to become even bigger in the next decade. So they're well positioned for that. They only have a yield of like 1.85%. Like they're under 2%. So that's another great business that offers you some growth, also offers you a nice little income on the side, something you would overlook if you were just looking at yields. So I think that's just another thing to keep in mind.